Good afternoon, everyone, and thank you for joining us today. A big shout out to Jay and his team for hosting us in Vancouver. For those of you who were in the presentation with Rick Rule, he said, if you don't have a reason to own it, don't own it. I'm really hoping over the next 10 minutes I can give you a reason to own OR Royalties. For those I haven't met yet, I joined OR 5 years ago, and I have over 15 years of experience in mining-focused capital markets, roles spanning research, sales and trading, corporate development, investor relations, and sustainability. Today, I have the privilege of leading sustainability and stakeholder relations at OR. Before I begin, I'll draw your attention to our cautionary language. I will be making forward-looking statements, which are subject to the risks outlined in our public filings, and unless otherwise noted, all figures are presented in US dollars. Some of you may be thinking, who is OR Royalties? While the name may feel new, the company is not. This past June marked our 11th anniversary. Many of you have known us for years as Osisko Gold Royalties. As of May 2025, we've continued forward under our new name, OR Royalties. The rebrand was not about leaving our history behind, quite the opposite. OR reflects both our ticker symbol and the French word for gold, honoring our Quebec roots and our long-standing focus on precious metals. Rather than revisit our origin story today, I want to focus on where we are now and where we're headed. At inception, OR had 1 producing asset and 4 exploration assets. Today, we have 22 producing assets, more than 195 royalties in streams, and a senior quality portfolio anchored by our cornerstone royalty on the Canadian Malartic Complex. That scale and asset quality are reflected in a market capitalization of over $11 billion Canadian today. Stepping back for a moment and to ensure we are all on the same page, as a royalty and streaming company, we do not operate mines and have no capital or operating cost exposure. We finance the sector and in return receive a percentage of production or a percentage of revenue. This is a highly efficient and scalable business model. With fewer than 30 people across 3 offices, we operate a dual-listed TSX and NYSE listing. Our model insulates shareholders from cost inflation and execution risk while providing leverage to metal prices, mine life extensions, and exploration success. So, what are the reasons to own OR Royalties? I would argue there are 4 key differentiators. Number 1, exceptional exposure to Tier 1 mining jurisdictions. Number 2, the leader in terms of cash margins. Number 3, we have visible, fully funded organic growth of approximately 40% through 2029. And last but not least, we have the most valuable gold royalty in the world in our cornerstone asset, Canadian Malartic. Let's dig into each one of these a little further. OR Royalties leads its peer group in exposure to Tier 1 jurisdictions. Approximately 80% of our NAV, or 80% of our cash flow, comes from 3 jurisdictions that we define as Tier 1, that being Canada, Australia, and the US. I should note that if Chile were included in that definition, our Tier 1 exposure would exceed 95%. In an environment where commodity prices have risen sharply and governments are reassessing their approach to mining through taxes, royalties, and regulatory frameworks, jurisdiction matters more than ever. Against that backdrop, having a portfolio concentrated in Tier 1 jurisdictions provides meaningful stability. It positions OR to benefit from rising prices while limiting exposure to policy-driven volatility. We also lead on cash margins. Our royalty-weighted portfolio delivers structurally higher margins, allowing shareholders to retain approximately 97 cents of every dollar of revenue generated. Why does this matter? In today's rising precious metals environment, that margin structure provides direct and transparent leverage to commodity prices. The third differentiating factor is our growth profile. As this slide shows, we have approximately 40% growth from now over the next 5 years, with a whole host of assets that fit within that Tier 1 jurisdiction. I should note that our updated 2026 guidance and refreshed 5-year outlook will be released in the coming weeks alongside our 2025 financials on February 18th. And the last differentiating factor is our exposure to Canadian Malartic, an exceptional mine, one of the most profitable in the world, near Val d'Or in the Abitibi region in Quebec. As many of you would know, Agnico Eagle, the operator, has a vision of taking Malartic to over 1 million ounces per annum over the next 5 to 6 years. With a roughly 5% NSR, or net smelter return royalty, I think everyone can equate to what that means for ourselves and our shareholders. This isn't just a flagship asset for OR, it's a benchmark for the entire industry, and it set the standard for the type of high-quality assets we pursue. Speaking of pursuits and acquisitions, how do we fund the business going forward? A key milestone in 2025 was becoming debt-free for the first time in a decade. Following a multi-year deleveraging effort, OR has now approximately $142 million in cash and accumulating more and more at these commodity prices every day. A fully drawn $650 million credit facility, a $200 million accordion, and roughly $160 million in marketable securities. To add that all up, it's over $1 billion in available liquidity. This balance sheet strength gives us flexibility to pursue high-quality opportunities while maintaining discipline. None of this growth comes at the expense of shareholder returns. Since 2014, our dividend per share has increased by roughly 150%, including a 20% increase in 2025. Almost $280 million has been returned to shareholders through dividends since inception in 2014. We have also repurchased approximately 9 million shares under our NCIB, using buybacks opportunistically when we believe market prices do not reflect intrinsic value. To close out, what I thought I'd spend just a bit of time is sharing a few stats as it relates to the M&A market within our sector, because it was a very interesting 2025. And by market, I'm talking about royalty and streaming acquisitions as well as corporate acquisitions. As you can see on this slide, in 2025, it was an all-time record in terms of M&A, almost 3 times from 2023 to 2024 at over $9 billion. What OR Royalties has done over the course of 2023 and 2024, as you can see, is participate in roughly 10% of the aggregate deal volume of about $2.6 billion and $3.5 billion, respectively. In 2025, however, we were only $25 million of that $9.3 billion. It's not that we didn't have a desire to do deals, we were in every single one of those processes, but ultimately chose not to deploy capital where valuations, jurisdictional exposure, or security structures didn't meet our standards. As you can see on the right-hand side, 55% of the deals were done outside of what we classify as those Tier 1 jurisdictions. More than half of the transactions occurred in jurisdictions we weren't necessarily comfortable with, and 26% of $1.3 billion of deal value involved unsecured structures. That is a red line for OR. We need security in any of our instruments going forward. And so we came very close on several transactions, but ultimately chose not to proceed, where security terms were weakened, particularly on streams. That decision reflects discipline, not hesitation. We have ample capacity to deploy capital. We're debt-free, generating strong cash flow, and highly liquid. And when we feel our shares offer better value, we return capital through buybacks. In 2025, we repurchased approximately $50 million Canadian under our normal course issuer bid. We do want to deploy capital on acquisitions, but only where transactions are clearly accretive to our shareholders. As I mentioned at the outset, 4 things define OR Royalties: our Tier 1 jurisdictional exposure, our peer-leading cash margins, our visible and fully funded growth, and our cornerstone asset in Canadian Malartic. Together, these attributes position OR to perform through cycles, not by chasing volume, but by working hard, remaining disciplined, selective, and focused on per-share valuation. As Charlie Munger put it, the big money is not in the buying and selling, but in the waiting. Thank you for your time. Not sure I've left time for questions, but please come visit me at booth 228 if you want to learn more.